Yeah, well, you can do all of those things. But the reason why I'm asking the question is because you kind of the answer is it depends. It depends on why you're doing valuation. It depends on what you're valuing and for what purpose. Let's start with that. The valuation of something that somebody inherits versus somebody needs to sell is going to be very different. There's going to be a lot in common, but there are going to be very important differences. The valuation that trades in something that trades in an active market, like a share of stock of Microsoft, it's going to be very different than the value of valuing a healthcare individual doctor's practice, which is non-public. So, and that brings us to kind of the first two questions that are posed on the board. What are the basic areas of needs for business valuation? Well, I mean, the first is for selling assets, right? So we can talk about valuation in exchange versus in use, right? Are you valuing an asset for a potential sale, like company A is buying company B, like an merger and acquisition transaction? Or are you valuing it for a purpose of whether you want to hold an asset for a potential synergetic use, for example, or you want to add it to your portfolio of assets? What's it going to be worth to you? Because its value will be different to you versus if it was being sold. So there's the notion of value. That's the notion of valuation premise. Why is something valued? For what context is something valued? So the basic needs of valuation vary. There could be as simple as valuing, what we classically talk about in finance, in the corporate finance courses. We talk about valuing securities. What is IBM worth? What is shares of common stock of IBM or Microsoft worth, or NVIDIA? Now, this is different than what is its current price. Because when you say, well, what is Microsoft worth what is it truly worth? We're talking about what's called a fundamental value. What we believe is it truly worth. Not what's necessarily it's trading at right now, which is what its price is, right? What is it truly worth? That's a fundamental value. That's also the other term for that is intrinsic value, right? What is it really worth? The shares of stocks. It could be shares of stocks, it could be corporate bonds, it could be digital assets, things like that. Public companies are easier to value than private because public companies have a lot more information available to you, and there's a lot more comparable information. You can compare more easily across public companies than you can across private companies, because public companies information by definition is public. That's why it's called publicly traded. What makes something publicly traded is they're registered on an exchange, and because they're trading on an exchange, whether it's NASDAQ, whether it's New York Stock Exchange, or over the counter, like pink sheets, whatever, they have to be then registered, meaning subjected to the regulatory regime of the U.S. Securities and Exchange Commission. Right? So that means they have to supply periodic audited financial statements every year. They're subject to various rules like Regulation FD, Regulation G, whatever. This is beyond the scope of this class. But if a company is a public company, there's a lot more external regulation on it from the anti-fraud perspective than there are on private companies. General public companies are more transparent by definition. They have to be. Private companies don't have to supply anything to the market. They're private. They're privately held. Now, they still do produce financial information. We still do get an opportunity to learn something about them. It just becomes much more challenging, and it is much more subjective. But the easiest thing to value would be a public company, and then the next level is a private company. Now, how do we value private companies? We use whatever we can do methodology for public companies, subject to some adjustments and sort of rules of thumb or whatever. And that's what we're going to talk about in the second class. That's another area of valuation. Now, that's what we value, what we value. And then the other question that becomes is why we value it. Why? What versus what? Why? That's the, are you valuing it as a financial analyst, like an equity analyst, because you just want your clients to buy or sell that stock? That's one reason. Or are you valuing it because you are targeting this company for a potential acquisition? That's a different premise. Are you valuing this company as for liquidation purposes versus a going concern? That's another. It's an operational premise. How are you going to use it? Are you just buying the assets and you're going to close the company down? You're going to continue operating it, then you're going to merge it through with its operations. So all of those things, like, and you have some readings too, and I actually here I used ChatGPT today as I was preparing for this class to basically take some of these readings from e-reserves and some of the articles, and I combined them into the slides here. And that's what ChatGPT is really good at these days, is that it's it really condenses information and something more easily readable. And if you don't have the time to read the articles that they were assigned or read the stuff from e-reserves, this is all kind of summarized in the slides. See it. Okay, so
have you found that ChatGPT with its content is generally pretty accurate in its summaries that it pulls together?
Yeah. Okay.
Okay.
The summarization feature is amazing. But
Sounds good.
Look, it's obviously my opinion, but I know this stuff, right? So when I read it, I can tell you like if it's BS or not. So, and for this stuff, it's pretty accurate. I'm not saying it's always accurate. In fact, it was a very funny. You have to be careful, because every once in a while it says something wrong. But it's even in this whole year that I've been using it fairly actively. It's amazing how accurate it's gotten in the last 12 months.
True.
It's amazing. But you do still need to kind of don't be like that one lawyer that just used ChatGPT to write their brief, and that brief was all non-existent cases. And there's a difference, I would say, between summarization feature when you know what when you give it information and then ask it questions about it versus ask it to produce information. Obviously, when it comes to it's still not good with respect to, I would say, citations, even though I haven't checked recently, and maybe it's gotten better. But here I know the material, so I can tell you that this is all fine in my opinion. So these are basically slides, and the reason why I'm telling you, and the slides also were AI. I just uploaded to there's Google Chrome has a slides.ai extension, which is actually free. Not entirely, but generally, all of the, just so that you understand, and you need to know this. It's like why I'm showing this to you. This 60, how many slides is it? 67, I can't tell. 57 slides. Took me about, I don't know, half an hour to generate all of this. So just this is how powerful these things are. And I was reading, Wall Street Journal last week was talking about it, that you guys got to know this if you want to get a job. Got to be able to use it. That's why I'm showing it to you. Anyway, so we talked about why, which is the premises. Now there's the third question asks, what is the difference between fair value and fair market value? Right, so we can talk about value now. So what is that we were trying to produce? Now we just answered why. And what is it that we're trying to produce? So it depends on why. So the short answer of this is, if the answer to the question of why is for an exchange purpose, right? You have to think about the situation. Are you valuing something because there's going to be a transaction between the parties? right? And the transaction within the parties presumes that there's some sort of it's a laissez-faire exchange. It's a quid pro quo exchange, and people wouldn't agree to a transaction unless they they get what they want, right? So in that case, it implies there is some sort of a fair market, right? So you're trying to that's what fair market value is for transactional purposes. Now, what is fair? How's the fair value different than fair market value? Does anybody have any thoughts on that? Brendan, you're muted if you're talking. I don't know.
Sorry, I was gonna say like wouldn't this be more of just a transaction between two parties as opposed to a transaction that would pertain to the market overall?
Well, two parties is defines the market is defined when there's more than one person involved. That's
Yeah,
what the
yeah,
market-
but I'm saying like this is not a transaction or a sell or a buy that is open to everyone in the public. This is more so of a transaction that's open to maybe two parties specifically. I don't know if that makes sense, or I'm not
I think you're
exactly sure how
getting
to
at
phrase
it,
it.
but you're not articulating quite what you were going to say. So yes, let's think about the word fair value and the emphasis on the word fair. What does that mean? Any lawyers in the?
More legal.
It's more legal, but what does fair value mean? Fair implies, what's the other word for fair?
Equitable.
Equitable. What else? Just.
Reasonable.
Well, yeah, but just or equitable, right? I think would be good. So the fair market value implies what? It's fair, whatever market decides is fair, right? Doesn't necessarily mean it's fair in kind of absolute sense. Does that make sense? Right? So market, market's fair. Market, it's like my children say, well, that's not fair. Well, life is not fair, right? Like, right? Life is life. That's kind of what fair market value is. You need to think about what would people agree to pay in a non-coerced exchange. That's what the fair market value is. But fair value is kind of a higher level of fair in a way, right? Does it sound like? So, for instance, and as Brendan, I think, was trying to tell us, fair value doesn't imply that there is, in fact, a market. It's more about what's fair compensation. So, for instance, two parties are getting divorced and there is a business involved. Right? What's fair? The wife never worked. What is fair for her to get? That is fair value. Not about what market would tell her to give to her, but what is fair for her. Or you're a shareholder in a company and that company got sold to another company and you didn't want to sell your stock. And you sue to block the merger. And you say, whatever, $25 a share in the standard offer that you guys gave me is not enough. I am entitled to 50. I really believe if this company wasn't sold, eventually I'll be able to sell it for 50. That's not fair. You have to pay me more. So you can think of fair value as sort of a valuation in compensatory settings in a way, right? It's not about what's in exchange. It's more about, well, this person suffered and what are they entitled to? Does that make sense? Now, that's more a philosophical distinction. Now, what practically it comes down to is whatever the local state law imposes in a particular situation. So some states will impose, depending on the valuation situation, a fair value standard, and it's almost the case. Fair value will almost always be the case, I would say, in shareholder dispute transactions, like what I was telling you about. If there is a lawsuit from a minority shareholder that believes got basically got the bad side of the merger deal, right? They got bought out for too low. That's a fair value, and they would go to court and sue, like let's say in Delaware court or something, wherever the company. And so it's important to know from the lawyer's perspective, an economist's perspective, what standard is applicable here. Now, why is it important? And we'll talk about, and we'll understand more of that as we go through in the second part of the class. We're going to talk about something called marketability discounts. Marketability discounts are applied when typically there is a lack of market on an asset, there's lack of liquidity on an asset, like let's say private company, right? It's not traded, so there's like it's harder to sell. So you have two companies, one all identical in all terms, in all respects, one public, one private. Public will always be more expensive. Why? Because there's less uncertainty about its liquidity. You can always sell it more easily because there isn't a market for it. For private company, there isn't. So the difference in this value is called marketability discount. So marketability discount inherently is a fair market value concept, But whenever we deal with fair value, there is no marketability discounts because there's no market. It's not about market, it's about what's fair. Does that make sense? All right, so and that basically is kind of, let's see, fair market value is a widely used standard value in judicial and regulatory matters, particularly in federal and state tax issues. It represents the price in which the property would be exchanged, or the asset, really, not the property, the asset, the company, whatever, would be exchanged between a willing buyer and a willing seller, with both parties having a reasonable knowledge of relevant facts and no compulsion to buy or sell. Okay, and these are very important things. And this is absolutely the right definition that ChatGPT gave. Absolutely 100%. Except I wouldn't use the word property because property makes it sound like it's only real estate. It's just an asset, right? A willing buyer and a willing seller, that's what defines the market, right? Nobody is compelled to act, right? Now, why is that important? Why is that important? Because we don't want to be like, for example, in a situation, let's say, when the government of Russia expropriates assets of American companies, which it's done when the Ukrainian war started. And the shareholders of those companies go to the court, and then whatever, there's a commercial court of arbitration in Hague, and sue the Russian government. Right? They're suing it for compensation. They're going to be suing not for fair market value because they were not a willing buyer and a willing seller. They'll sue for fair value of the assets that they lost. Does that make sense? Both parties have reasonable knowledge of relevant facts, meaning there's enough information, like, to make, and no compulsion being the key. Okay, so fair market value is the price agreed upon by independent parties in an open market transaction. Does not consider any special motivations or synergies that may influence the price, right? So why is that important? Because synergy stuff comes in the investment value transactions, right? When you buy to grow your business or to grow your revenues, that's more for investment purposes. So there is not, you don't consider that. The asset would change hands between a willing buyer and willing seller. Neither the buyer nor the seller is under any compulsion. Both parties have reasonable knowledge of relevant facts. All right, so you can see there, the tax people, that the fair market value is important for tax estate valuation purposes. Now, why is it not fair value rather than fair market value? Why is it fair market value rather than fair value? Again, because in the state and in the state tax law, it's not about compensating anybody. Hypothetically, you want to tax something that the inheriting party could sell these assets for, right? So that's what you want to impose the tax on. Classic example that I think I even mentioned when we're talking about intangibles was Michael Jackson. When Michael Jackson died, IRS tried to value his estate at much higher. Not just the estate. It wasn't about the house. It was more about his music. And I forgot what the number was that IRS was claiming. It was, I don't know, 150 million or something. I don't remember now. At the end of the day, it went to, his descendants sued and said, what do you mean? Like, because IRS wants to tax more of it. That's the bottom line. That's why they claim a higher value. They said, well, first, it's not like you can go and sell this music like so easily, right? Somebody has to buy it, right? And it's interesting, the tax court ultimately ruled at a much lower number, I think 90 million. And the argument was that this music is not as, and expected to be as high of a demand, if you, for lack of a better term. Divorce cases depends on its relevance. Some states are fair market value states when it comes to divorce. Some states are fair value states. So that's where if you're ever in this business, you really need to know the law of the state in which you provide evaluation, and the lawyer will tell you what the standard is. Now, practically speaking, it basically comes down to whether you're going to use marketability discounts or not. That's what this comes down to. If it's a fair value standard, no marketability discounts. If it is a fair market value standards, yes, marketability discounts. And damages, compensation, and so on. So that's fair market value. Then there's the fair value. So fair value is a standard value used in various contexts, including financial reporting, appraisals for descending shareholders, buyouts of oppressed shareholders. We talked about this, the disputes, fairness opinions, and divorce. So divorce, I told you, could go both ways. It provides more precise and equitable value. Equitable. See, you guys said equitable. Good. We talked about equity of specific situation compared to fair market value. So far, ChatGPT is doing a pretty good job. Fair value is the price that would be received to sell an asset, pay transfer liability in orderly transactions with market participants at a measurement date. That sounds like almost like a fair market value, but it's a hypothetical. It would be, right? In other words, there is no fire sale. There's sort of hypothetical transaction given like what truly the asset is worth. What would you sell it for? Slight differences. Emphasize orderly transactions does not require buyers and sellers to be well informed as fair market value requires. In other words, on the fair market value, it doesn't have to. If the market doesn't value this asset very well right now, it doesn't matter. Maybe that is not truly, it should be worth more. That's what market wants for it. So that's that. So we talked about that you can read that on the side. We talked about equitable valuation. Investment value. Investment value is a standard of value that reflects worth of an asset, business interest to a specific owner or prospective owner, right? So that's the M&A, merger and acquisition. Company A buys company B for a typically specific purpose. It wants to do something with the assets. Either it wants to expand its market, customer base, it wants to acquire patents, it wants to acquire human capital, what have you, right? So, and it will acquire from that synergies. And what's synergies? Like this fancy word. When I came to America, it's one of the first words I learned in the business school when I was an undergraduate. Synergy sounds really cool. And it's like the story that 2 + 2 = 5, right? In other words, there's something that will come from this merger that will generate additional value over time. It underlies the sort of the goodwill values that are generated, which is the excess value companies pay over the fair value of net assets. Most synergies are not realized. It turns out to be rather bogus, but theoretically speaking, you really buy in this for a reason. That's why there is an investment value to it. I talked about the synergies. We can skip that. All right, so you always have to think about why you're doing it, what are the operational objectives and strategies. That's investment value. Really, investment value, I would say, is most relevant to primarily to strategic acquisitions. That's where it's, and maybe internal valuations as well. Marital dissolutions, it depends if the state allows it or not. There's, that's something that's less so. Intrinsic value, that's really what we love to talk about in corporate finance courses. So I know to those of you who are finance students, discounted cash flow that you do or excess return valuation, that's fundamentally the estimation of intrinsic value. What is the long-term fundamental value? The other term is fundamental value, what this asset is worth. And what we teach you that any asset is, any asset, well, that's why I started with the iPhone. I mean, conceptually speaking, what's the value of the iPhone? The value of future cash flows is that this iPhone will generate. Whether you value an iPhone, whether you value the house, whether you value damages, it's always think about the future cash flows of an item, and you discount it backwards and to the current time, right? That's why I had you guys review present value calculations. And that's what the value of an asset is. That's what the fundamental value of an asset is. When it comes to marketability discounts, things like that, these are all adjustments after the fact. They are adjustments actually to the fundamental value, right? The discounted cash flow value is the fundamental value. So you can review all of that. All right, so talked about exchange, valuation premise. Now, the other thing also what's important is, are you valuing the company as sort of in a normal state of affairs? It's not like it's not about go out of business, and that's called going concern valuation. If the company is distressed and there is a real concern that will just not survive, that's not going concern. That's a liquidation premise, right? Essentially, the company is just trying to fold. And then at that point, when the going concern, you do the regular discounted cash flow valuation. Typically, you will forecast out 5 years. And after that, you'll consider, and you'll talk about this, and you'll forecast terminal value. Liquidation premise, you can't do that. The going concern implies the company will survive at least 12 months. If there's a concern that the company might die in the next 12 months, then essentially you just value the remaining assets after you pay off the debts, right? So it's no longer a company. You now have to value just what's going to be left of it to the remaining shareholders. Now remember, in bankruptcy, creditors are compensated first, right? Equity holders are compensated when? Last, right? So essentially, when you deal with liquidation premise or valuation, you would have to think of, so, okay, well, what is it? You have to value just the assets on the presumption that those assets will not be going concern, that there will be no continued value for them beyond, a short horizon. And well, essentially, it becomes like, what will, if I have to close down tomorrow and I have to sell everything off, what will the market give it to me? And like, for this, right? So, classic example is Kodak. Kodak. You guys know the story of Kodak? That wasn't that long ago. Anybody? No. So, everybody knows what Kodak is. Like, still before the iPhones, there were real cameras. Remember that?
So I can try to remember. I think Kodak is the company that was more. They used to use the manual cameras with films.
Yeah, and then
So
digital
and
cameras.
that wasn't valuable in that didn't it was very valuable during its time when digital camera was not invented. Then what happened was they ran out of the market when digital cameras were introduced. They no longer could do the substitute business because their main business was not selling cameras. The films were important.
Yeah,
That's
that's
how the
exactly
business
right.
lost
Eventually,
value.
Kodak went bankrupt, right? So that to make
Yeah.
long story short, and Kodak actually was sold, but mainly for its patents. There was no value in the firm itself. The value was in patents that it had, because patents entitled to hold those, because whatever technology those patents were patented was more valuable individually rather than as a whole. So a situation like that, that's when you have a liquidation assumption, essentially. Right, and then you have to think about if this is the fire sale versus the orderly liquidation. If to sell tomorrow, then obviously the value is lower than if you can sort of slowly unfold things in the orderly fashion. So that's that. Okay. Then I gave you a summary of sort of like a couple of court cases. This is from the suggested material. This is like, I'm not going to put this in an exam, but like, if you're interested, it gives you a good summary of how those concepts are applied in court, right? In litigation, right? And because this valuation issues come up. So this class, the reason why I wanted the law students in this class is because like this issue of value, it's a really legal, like the biggest consumer of that are the lawyers, right? Because you litigate over what something's worth, litigate over the value of damages, and the valuation reports are, produced routinely for court cases. So there's some examples of how, the valuation methodologies were applied. There are two different experts. There's always the defense expert and there's the plaintiff expert. and they argue over it, and because generally when experts argue in court, they argue over assumptions and methodologies, right? Because one expert obviously wants to show the higher value, the other expert hopes to show the lower value, right? They're not supposed to advocate technically, but they still work with their clients. And I have a lecture that you could watch on expert witnessing. So but that's what it comes down. This stuff comes down to, and here are some examples of what went into that, and so on. So that's kind of the module 0. Any questions on that? Is that clear? Okay, so why don't we take I don't know, a break till 7:15? Go to the bathroom, whatever. I can call back my mother, who called me twice now. And let's be back here at 7:15. Is everybody okay with that? All right. Hello, everybody. Let's come back. All right. So we covered. Any questions on module 0?